Does Medicare pay for hearing aids? And unfortunately, Medicare doesn't pay for hearing aids, but this is an alternative that might help you cover the costs of your hearing aids, not only today, but throughout the rest of your retirement. So hearing aids can be really expensive. So the average cost of a set of hearing aids is $5,000, and the average lifespan of hearing aids is 4 to 6 years, depending on the manufacturer and the type of hearing aid that you have. And on average, hearing aids cost about $1,000 a year, and you're going to typically spend about $20,000 on hearing aids during your retirement. So how are you going to pay for them? So Medicare, we already know, is not going to pay for exams, fittings, or the hearing aids themselves. Medicare Advantage plans, it depends, but on average, they're only going to pay for about 20% of the hearing aid costs and fees associated with them. So then you may want to look at your retirement savings as a way to pay for them. And that may or may not be a good idea depending on your income levels and how much money you actually have available in your retirement assets and savings. If you've got family that financially can help you out, that's awesome. Most people don't. But if you're a veteran, the VA may pay for your hearing aids. So if you're a veteran, you do got that going for you. But let's assume you're not a veteran, your family can't help, you don't really want to draw a bunch of money out of your retirement savings. The question then is, how are you going to pay for them? So let's take the look at Tyler. So Tyler is 65 years old, $2,800 a month of income. He owns his $480,000 home, free and clear, no mortgages, $45,000 in retirement savings, and he needs hearing aids, which are going to cost $6,500. And, beyond just his hearing aids, Tyler's worried about, increased daily living expenses with inflation the way that it's been, and he would love to have another source of backup funds for when other large expenses pop up during retirement. So whether that's car repairs, home repairs, or other medical expenses. So Tyler reached out to me to see about this alternative way to pay for his hearing aids today as well into the future. And so what we're looking at is, for Tyler, is him getting a reverse mortgage. So his reverse mortgage is represented by this bar chart here. So the blue represents the home value, and we're assuming a 4% appreciation rate. The orange represents his loan balance, and initially Tyler is going to draw out the funds that he needs for his hearing aids, and he's going to lump in the closing costs and actually pull out a little bit of extra cash too. And so he's going to start off with a loan balance initially of $29,000. Now we can see this loan balance is increasing over time, and that's because we are making the assumption that Tyler is not going to make a monthly mortgage payment towards the reverse mortgage. He still has to pay his property taxes and his homeowner's insurance, but because he's not making a payment, the interest in the mortgage insurance is getting added to his loan balance every month, and therefore the loan balance grows over time. Now the green represents a line of credit. And so beyond lumping in the closing costs, pulling out some cash initially, Tyler has a $135,000 line of credit. Now we can see this line of credit is growing over time, and that's because any funds available in the line of credit grow at the current interest rate plus 0.5%, which is pretty awesome because we can see by the time Tyler is 80 years old, he has $398,000 sitting in his line of credit at a time when his expenses are probably going to be larger through healthcare costs. He may need assistance with taking care of the house or the property. In general, his expenses are going to be higher. Now, Tyler doesn't really like this idea of this loan balance increasing. And so what Tyler does is he decides that he's going to start making a monthly payment. He would have made a payment anyways had he financed his hearing aids in any other way. So Tyler decides to make a payment of $400 a month. Now, again, the blue represents the home value. That hasn't changed at all. But if we look at his loan balance, the orange, we can see that in just 10 short years, Tyler has this thing almost paid off. And in 10 years, he just stops making a payment. All right. Now, what's really exciting is if we look in 10 years, Tyler would be 75, as he now has a $338,000 line of credit. Had he not made the payment, it was $278,000 in 10 years that he had available. So basically, by making that $400 a month payment, Tyler has increased his line of credit by over $60,000. The reason that that's happening is because any payment that Tyler makes towards the reverse mortgage not only pays the loan balance down, but it increases his line of credit. And here's the beauty of that, is that all the funds that he does pay towards the mortgage increases his line of credit, but those funds are then also growing inside of that line of credit. So we can see by doing that, even though he stopped making payments in year 10, his line of credit is expected to be $483,000 in year 15 when he's 80 years old. So here's the other beauty of the reverse mortgage line of credit. Should Tyler draw any money out of this line of credit at any point over the next 15 years, he still doesn't have to make a monthly mortgage payment unless he chooses to do so. He still has to pay his property taxes and his homeowner's insurance. But what this has done for Tyler is it's created another source of funds for him to draw from to deal with those expenses that are going to pop up throughout the rest of his retirement. Car repairs, home repairs and maintenance, healthcare expenses, things like that. And so for Tyler, this does double duty. He's got a way to pay for his hearing aids initially, plus he's setting up another source of funds to deal with those large expenses in the future. So, again, paying for hearing aids with a reverse mortgage, it just gives him access to income tax-free cash to pay for those hearing aids, both today and into the future, right? Because his hearing aids are only expected to last 4 to 6 years, and now he has another source of funds to draw from to pay for new hearing aids when it's time. He doesn't have to finance them to take on additional monthly payments, right? So a care credit card, a personal loan, he's not having to finance them and take on additional monthly payments if he doesn't want to. If he does make payments, all those payments make additional funds available. So as we just saw, by Tyler making those monthly payments, not only are we paying that loan balance down, but we're increasing that line of credit. It helps retain his retirement savings. So Tyler was only starting off with a pretty nominal amount of savings. And so instead of drawing throughout those through the next 15 to 20 years just to pay for hearing aids, he can retain those savings and use them for other things. He may not need any financial assistance from his family, because now we've set up the reverse mortgage and have access to those additional funds, and he's better prepared for other large expenses during his retirement. So you want to see how this would work for you? You want to see your numbers? You want to see some forecasting to see if this makes sense, if it makes sense to make a payment or not make a payment? Give me a call. Happy to run the scenarios for you, put your numbers together, and answer any questions that you have about the reverse mortgage. I look forward to hearing from you. Thanks.